Welcome back. Some kind of a pullback is what we're seeing, particularly on tech names. I think we should pull the tech index up for you. It's still down, but there's been a good recovery from the low point of the day, and particularly in this hour itself. Tech Mahindra, Wipro, TCS, they are the top winners in this hour on the Nifty itself. So some kind of a pullback. Well, par for the course. You still have only around 113 stocks that are advancing, which compares with 2,500 stocks that are declining. Rohit Srivastava, founder and strategist at Indiacharts.com, joins us on the show. Hi, Rohit. Well, the bears are on top. We've seen a sharp pullback. If you want to look at it on the bright side of things, India is pulling back less than what the globe has pulled back, but still it's a pullback. What are the levels you're looking at on the Nifty from here on? Do you think we're trending lower? If yes, how much more is the downside from here?
So I think the first thing we have to do is accept that we have entered a bear market. And that's the hardest part to do, because you can continue to justify the previous trends that were going on for very long. Having said that, any bounce over here, and there can be a bounce because we do have very short-term oversold conditions. If you look at the hourly RSI down to 8, or if I look at our own proprietary momentum swing indicator, which is currently hit even 0 intraday, that tells us, okay, you'll get some recovery. But the point is this going to be a meaningful recovery? And the answer is probably not. I mean, one of the two things will happen. Either you will test the gap that we've left behind from Friday to today. So 22,300 plus or minus is one level at which you might go and then stay there for a while and sell off again. The second could be that if there's any positive news trigger in the short term, you can get a deeper retracement of this entire fall from 23,800. So that can even give you a sharp pullback to 23,000. Problem is we don't know which one. But what we do know and what we do think is that any bounce, small or big, is going to get sold into. Don't anticipate a very big bounce. The odds appear low right now. But a small one is definitely possible. So, people who are looking to sell should probably wait. But this is not a time to really be, buying or even nibbling into the market, hoping that things will stabilize and, life will go on as normal. So I think that part is behind. You should really wait for things to ease out before you start doing that. But be prepared for, some more volatility in the weeks ahead.
When we spoke to you just last week, you had indicated that this 22,930, which was the March low, would act as an important support and markets could bounce. Today, we've tested it. We went down to, I think, 22,750 thereabout. But what happens to that, 22,930, which was acting as a support? Is that now out of the window?
Yeah, we broke 22,930 on Friday. We closed below it, and we've gapped down. So today we are almost at 22,000 now. So the break on Friday itself was indicative that the potential for it to go to 24,000, which we were thinking, is out of the window. So just that was our stop out level. So we pretty much closed out everything on Friday based on that. But what we are looking at now is, do we really enter? Because that was the bullish trade, which started from, say, 21,900, went up to 23,800. That bullish trade is out. And unfortunately, that advance, so usually if you get an impulsive advance, which in Elliott waves, we say you go up in 5 waves. If that was the case, we could have said buy the dip. That didn't end up happening. Now that means that it's a sell on rise market. Every time you get a pullback, you get a rally, there's an opportunity to sell again. Unless something changes in the structure. So the structure is pretty much broken. In fact, on Friday, we also didn't just break daily levels, but we also broke the 20 and 40 weekly averages on Friday. So sort of all the levels that we had gone above were given back on that day itself. And now, unless we really can get back there, I think we should continue to expect that we are in a downward trend. Now, question is how much downside then? So I think all hopes lie on the election low. We made a low of around 21,280 odd, I think, plus or minus few points there. Will we stop at 21,300, 200 at that point? I think this puts the whole guesswork on what is going to happen on the global macro front. Because when global macros are in bad shape, then I don't think it's possible to hold that level. That level holding would mean that we are not getting a US recession. We'll sort these things out in a matter of days, and the panic will end. So that would help us hold 21,200 and the bull market resumes. But if we are into a bear market, which means that we are presuming a US recession, these taxes remain, and I'm calling them taxes, essentially the tariffs are a tax, cause global trade to slow down, which is what most economists have started to anticipate, then it's not possible that you will hold 21,200 also for long, and you start anticipating levels below that. So levels below that would mean if we say 38% retracement of the entire COVID bull market, it gives us something like 19,800 on the downside. So we will slowly start opening ourselves up to, much lower levels moment we start anticipating that this is going to head into a recession.
Ouch, ouch. That's scary, Rohit. That's really scary. No one wants to think about the 38% retracement of the total COVID bull market. But you're right. I mean, we need to be aware of all possibilities. So, okay, let's just rewind back to what you've said. What you've said that, at least for traders, sell the rallies is a good way to go till there's further clarity. And who knows? Tonight you get a statement saying tariffs are on hold. We're going to negotiate for the next 2-3 months. It'll be a very different market tomorrow morning, right? So till we get that clarity, you've illustrated what traders can perhaps best do, sell the rallies. Now, for those who are looking at this market from an investment perspective, I'm talking about at least 1 year, not too long, but let's say they want to invest, they're not trading. For them, what is the advice? You just said that there is a possibility of much deeper lows. I mean, lows below 20,000 as well. Should they wait? I mean, how do they navigate it? Not the day-to-day traders or even the the positional weekly traders.
So I think they should be patient. They should really wait. I mentioned that we've broken weekly averages. So that gives us a cutoff point at the top end of where we are, 23,100, 200, wherever that will be. And with those, weekly levels as a trail, I think we should just wait because those levels will keep coming down as the market keeps falling. And so you'll have a re-entry point at some point in the future. But till you don't know where that is, trying to anticipate it or double guessing it would not be right. If these things get worse, then you are unfortunately getting in too early. So it's better to wait, let it confirm that the trend has changed from down to up before you start investing. Sometimes you also get certain extreme readings in terms of sentiment. Like in COVID, the VIX went to 90, and we've never seen a higher reading than that since 2008. If you end up in that scenario, then that also becomes a point where you say, oh, we've reached the point of maximum pessimism. So that has not happened. We sometimes do reach points of, medium-term pessimism, which is what happened on the 4th of March, and then you bounce. So those are readings we will continue to monitor. But I think investors basically need to be patient, give it 6 months, try to just see how these negotiations are going. Because when I look at what is happening in India, we are talking about bilateral agreements happening by the fall, which is basically August, September. So that's 5 to 6 months. Now, for 5 to 6 months, if you're going to have these tariffs in place and not going away, then you're talking of a meaningful slowdown happening in that time period in trade. So it's better to be patient for that time period than jump the gun. So once you can estimate that, this is going to take this much time to play out, then you'll not be in a hurry to, jump in.
Got that, Rohit. So, yeah, by the way, what is that level? What is that marker, the 20 and 40 weekly averages? Where is that at? Which is kind of which?
So I'll just put those out. Those levels are currently at 23411. That's the 20 and 23404. So very close to each other within a matter of few points. They're almost at the same level. You can generally say 23,410. And that level will keep coming off on the downside as time goes. And unless we really get past that, I think we should just be patient and let this play out on the downside. That's for investors. I mean, for traders, there could be opportunities to sell, to short, as and when, you get rallies.
Yeah. Got that. By the way, Rohit, you track a lot of global macros as well. You look at rates market, you look at currencies, everything pretty much. So anything standing out, or it's all showing the same kind of thing, right? Liquidation, self-protection. Even gold is selling off. So that is one. And second, in your opinion, you've also tracked this entire Trump presidency since the beginning, do you think it can change? I mean, they'll come back and say, well, not that they made a mistake, the way they've calculated these tariffs, but somehow kind of backtrack. which lets in some air here for markets?
I think only if there's a lot of domestic pressure. I'm surprised that the tariffs, which are a tax actually on American citizens in terms of their cost of living, are not protesting the tariffs internally. So if there was an internal protest, probably he would be forced to back off. Right now, that doesn't seem to be happening at scale. And he's actually talking them into being patient and letting things play out the way he wants to. So then that just leaves us with assessing the macro factors. I mean, a lot of people have tried to justify that this will result in a lower dollar and higher bonds, which means lower bond yields, which can be a good thing. Now, put this in two scenarios. If you asked me a month back, I was talking about, these same factors being positive for the market because money was shifting to Europe and China. So the difference is basically between a US slowdown and a US recession. So if you get a US economic slowdown, it means that stocks can be volatile but remain elevated. At the same time, money can move out of US into other markets because you have a weak dollar and low interest rates are favorable and you have stimulus happening in Europe, now even in India where we are increasing liquidity. So money can easily flow into these markets and they end up doing well. But when you talk of a US recession, the same factors are there. Bond yields are coming down, you have a weak dollar, but it doesn't work the same way because a US recession ends up leading to a risk-off trade which becomes global because now a recession means you are not just slowing down in the US, but you're slowing down the whole globe. So what these tariffs end up doing is they slow down global trade. It's not just India's trade with the US, which is what a lot of focus was initially on. It's India's trade with everybody because everybody's trade is going down. So if everybody's impacted, then you're indirectly impacted by everybody. So that is the bigger impact. So once you take that into account, then you're saying that this is a global risk-off that is now in place. And so we can't have that narrative where money shifts, from one market to the other. Everyone ends up suffering a bit. Eventually, you end up in a very good place because, see, if you think that you will sort this out in 6 months, that means you have 6 months of pain. Eventually, you sort it out, and then you have low inflation, low interest rates, and greater free trade in the world. Perfect place to be in, right? So the point is, what is the time the pain is going to be around for? Once you can assess the time, then you sort of have an idea that, okay, we need to be patient for this amount of time, maybe 6 months, maybe 8 months, till everything comes into a very good place from where we can have a new bull run.
Okay, all right, Rohit, appreciate you joining in. Thanks a lot for giving us that check on the markets as well as how do you see things pan out from here on. For the